Well, welcome back. Stocks are up this morning. Futures indicating a gain at the start of trading as we focus on the Federal Reserve's annual Jackson Hole Symposium, which kicks off today. Tomorrow, Fed Chief Jay Powell will speak, and he is expected to make comments at 10 a.m. Eastern tomorrow morning about inflation. Joining me right now is Oxbow Advisors managing partner Ted Oakley. Ted, great to see you this morning. What are you expecting from the chairman?
Well, I think it will be his usual information, Maria. You know, what he's been saying is, hey, we're going to fight inflation. We're going to fight inflation. That's the mantra. And if you look at some of the committee members, that's the same mantra. So I'm assuming he'll say that. And, you know, he sort of talks out of both sides of his mouth. So he'll probably also say, we see a few signs of weakness, et cetera, et cetera. But that's what I would expect.
Well, I mean, I guess what I'm asking is, has anything changed in your view over the last few months about how they're approaching inflation as the economy slows down? Because one reason we saw this strong rally in stocks, particularly big tech, in the month of July, was that some market participants thought the Fed was going to blink. And now they're worried that the Fed is going to double down and say, no, we're going to continue this aggressive tightening, in particular, perhaps another 75 basis point hike in September. We're getting the second read on the second quarter GDP this morning. That's out this morning at 8:30 a.m. Eastern, and we're expecting another contraction, a revision of negative 0.8%. Then we've got the July PCE report out tomorrow, another read on inflation. How slow have things gotten in your view, and what are you expecting from the economic data?
Well, Maria, we think the economic data will continue to slow down, but you have to think of the Fed. They act like this. They act like, well, if we maintain the same CPI number, the numbers that are coming in, PCE numbers, then we're going to go ahead and keep it strong in here for the time being. I know Wall Street wants that really badly. They love to have a period where we go back into declining rates, but that's not where we are in the cycle, in our opinion. We're at the spot in the cycle where they're going to just keep on raising them till we really do get a break. I mean, the economy's really slowing down, but it could go a good bit lower in here, and I think that there's two sides to the equation. On their side, the Fed side, they're not seeing it that way. I think, you know, you can really have some fairly high numbers through the end of the year, 6.5%, 7%. And so they'll probably stay on it. Wall Street won't get what they want.
You're saying 6.5% on what? Growth?
Oh, no, I'm talking about on the inflation number. 6.5%, 7% number on the inflation number, because, you know, even if you back off a little bit, you probably take it all the way to year end.
Yeah, okay. Right now, of course, we've got the consumer price index at 8.5%, and it was 9.1% the month earlier. Mark, jump in here. Your thoughts?
So Ted, there's all this discussion, debate on whether or not we're in a recession. And my perspective is this. I mean, the Fed, along with the Biden administration, they've been working so hard to pull out that Webster's dictionary and slap some white out on the definition of recession. And my take on that is the reason they're doing that is really to kind of subtly reinforce with America that the Fed has a dual mandate. Just two things: full employment and price stability, not avoiding an economic contraction or avoiding a recession, right? So that kind of has me believing that it's more likely that the Fed is going to hike higher and for longer than the market's been pricing in. So I'd love to hear your thoughts on that.
Well, you know, Mark, one of the things is that they always look backwards. And on the employment thing, people don't realize, but employment is a very lagging indicator. And that's the problem with too many people at the Fed that are not on Main Street. If you're an employer today, the last thing you want to do is let your good people go. And that's the last thing that happens. And so all of these other things can happen. If you just look around at all the information that's coming out in industry and all that sort of thing, it's breaking down now. But it's not in employment, but it will.
Yeah. At some point, it catches up, is what you're saying. Ted, how are you investing in the face of all of this? Have you changed the way you allocate capital or telling investors how to allocate capital?
Maria, we haven't changed a lot, but I will tell you, you know, we started a year ago almost now, you know, with high liquidity, much higher than we normally would do. But what it has created, this rise in rates, is there's some really interesting things in income out, even short-term income. I mean, people didn't used to be able to put money out for 6 or 12 months. And, you know, you can put money out there now for, you know, bulletproof for over 3%. So I do think it gives you some chances to do some things. I don't think there's, it's not like you're going to go all 100% growth stocks or something right now. But for us, we're less on the growth end, a bit higher on the income side, and certainly higher on the cash side.
Income side being dividend payers, Ted?
Not necessarily. Some examples I'll give you. We own the gas pipelines, 7.5% to 8% yields. We own some medical REITs, and we like those quite a bit, 5.5%, 6%. Believe it or not, Maria, some of the preferreds out there, particularly too big to fail banks, are now up around 6% or 6.25%. And, those are good places to park money that you can really get it. Yeah. And I'm talking about, that are, you don't pay the higher tax rate on. It's like an ordinary income yield. So I like that. We like that stuff quite a bit. Okay. And we also like short treasuries.
All right, well, you're talking about some pretty good looking yields there. That's for sure. Ted, it's good to see you.